Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Earnings season has kicked off with the big banks, and it's expected to be the worst quarter for many stocks in 12 years. Joining me to discuss is Caleb Silver, editor-in-chief at Investopedia. Caleb, great to have you with me as always. And one thing for sure is it's going to be painful for the bank stocks. So let's get an overview of the quarter and what to watch with earnings.
Sure, it's going to be painful for everybody, but especially the bank stocks, and it's already started. Although JP Morgan did report better than expected earnings, but it set aside more than $10 billion in what we call loan loss provisions. Wells Fargo also setting aside $8.5 billion in loan loss provisions. That just means they're buttressing their their capital markets to withstand foreclosures, to withstand bankruptcies. They're getting ready for a lot of pain in the economy by putting a lot of money aside. So that's where the profit's going. And the money they did make was from a lot of trading. There was a lot of trading activity in the last quarter. That may not be around in the next quarter. So it's a very tenuous time for the financial industry, especially the banks.
What other high-profile names are you watching?
Well, you got to watch Netflix, which reports this week the stock's been in an all-time record several times over the last couple of months because we're sitting at home, we're watching a lot of it. But you got to look at subscriber growth, especially around the world. It does very well in the United States in terms of subscriber growth. It does have new competition from Disney Plus and other players, but its growth area is outside the US. So we want to see growth there, and we want to see what kind of money they're going to be spending on new programming and what new programming they're going to be spending their money on, because who's making movies right now? So that's going to be an interesting stock to watch later this week.
Yeah, you're also taking a look at a food stock.
Oh, Domino's Pizza is one of my favorite stocks to watch because if I told you, if you look back over the last decade and I said, where would you have done better, with Domino's Pizza or with Google as a stock? You probably would have said Google. I think 9 out of 10 people would have said that. Domino's Pizza has been one of the best performing stocks of the last 10 years, of the last 15 years actually, and it's done very well in this environment too. So Domino's is all about growth and sustaining the growth, and also how do they rein in costs at a time when their profits are growing and their revenue's growing. People are ordering a lot of pizza at home, but it's going to be a little bit more competitive going forward here, and things are starting to cost more as they have to outsource for some of that delivery.
That's so interesting. I would have picked Google as well. So learn something new every day. So based on Investopedia activity, and there's so much data that you have there, is there anything you can discern about investor behavior around earnings?
Oh, this is a high time of anxiety and volatility for investors because they're curious about these companies and about how they perform. But when you look at the companies that have done the best, we're looking at Tesla, for example. A lot of our readers are wondering how to invest in it, what index funds hold Tesla, what ETFs hold it, how much money would I have made if I invested at the IPO. A lot of that Monday morning quarterbacking going on with some of the most popular stocks. But we also have a series of articles on how these companies make money because everybody knows the names, knows the brands, and are interested in these stocks as story stocks, but they want to know more about where the money comes from, where the revenue comes from, where the profits come from, who are the biggest shareholders. So we see a lot of interest in around individual stocks, individual companies, and their components in terms of what makes up their revenue picture. So we always get that. And then we always get a lot of questions about, are stocks overvalued? If I want to bet against a particular index, what's the best way to short it? You feel that frothiness right now as the market's been a little bit heavy, and investors sense that, and they're reading those articles on our site.
You know, it's a great point that you bring up, investing in a stock and understanding the fundamentals versus liking the product around which the stock, with the company that owns it. And I think, you know, maybe this is a webinar for another time, but when we talk about financial literacy, I think it's a really good point to make. And I remember this happened a lot earlier in the 2000s when it came to Apple stock. People were so in love with the product itself and still had to work through the fundamentals a bit. So I think that's a great point that you bring up.
Right, people get attracted to the name, they're attracted to the brand, they're a consumer of the brand, they buy what they like. But actually, if you look under the hood at some of these companies, the financials may not be what you're looking for, they may not be what you expected. So you have to get rid of that emotional attachment. We did a little survey and showed that a lot of our readers invest in companies because of the brand, and then they think about valuation, but it's brand first because that's their first association as consumers.
All right, Caleb, thanks for joining us as always on Trade Talks.
Thank you.
All right, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.